So a lot of people come to us, 1031 exchange. They're looking for something that would be more passive to replace something that had a lot of active management headaches. What options exist for 1031 exchange investors looking to go more passive?
Yeah, it's a great question because everybody ultimately is tired of management, and there's really only two passive ways to potentially invest from a 1031 perspective. And that's generally either a triple net property, which a lot of people are familiar with net lease properties, or the DST, the Delaware Statutory Trust. You know, there's an argument you could go buy an apartment building and hire a third-party property manager and, you know, be hands-off from that perspective. But we all know if you've managed multifamily, even at the highest professional level, it might alleviate some headache by having a property manager, but there's always a level of management and decision-making even with a third-party property manager. So that really, again, brings you back to I can invest in a net lease asset or I can consider DSTs. And there's pros and cons to both. You know, with a net lease property, you are, 100% owner of the asset. You have a little bit more control to the extent, especially as liquidity, because you can ultimately decide to sell that, which I'll address also in this discussion. And then where DSTs, they have a predetermined business plan. So you do need to be comfortable with whatever that potential hold period is. But again, a lot of the investors that come to us, they're at that stage in their life where they want to try to invest in something that's passive by nature. They're not in a stage of their life where they're flipping real estate and looking to liquidate 2 to 3 years from now. And so when you're in that stage where you can afford to be in a long-term held investment, the net lease and the DSTs could be very comparable. We always tell investors with the DSTs, if you need liquidity in 2 years from now, 3 years, 4 years, whatever it might be, if that's concerned, it probably is not the best vehicle for you. But if you are comfortable with a long-term hold strategy, there's a lot of potential benefits with the DST structure versus the net lease structure. And the biggest one is concentration risk. That's number one. The second is most people have not necessarily managed net lease assets. Definitely a handful of our clients have, or some combination of a net lease and maybe one of their commercial buildings they owned. But a vast majority of the net lease owning a big investment grade tenant, whether it's like the Dollar Generals of the world to the fast foods to distribution centers, shopping centers, it's usually newer to most people. People are moving from an active, single family house management, multifamily management to net lease or DSTs as their first time. And so what your biggest risk in a net lease asset is that concentration risk. Number one, meaning most net lease properties, whether they're in a DST structure or by themselves, you buying them by themselves or yourself, your biggest risk is the renewal of that lease, right? They might sign a 10-year lease, and that's great. You have a very strong tenant on that 10-year lease that as long as they don't go bankrupt, you're in theory getting that check as long as they don't, play any games or anything along those lines. And so people like that stability. But what happens 10 years from now? Do they go into their option? Do they renew that lease? And the other big factor when we go back to the liquidity nature of a net lease asset is net lease properties are historically a depreciating asset. And what I mean by that is when you buy it day one with X amount of lease term on it, so let's say 10 years, 8 years, or whatever it might be, your starting lease term is going to burn off. And so as you get to, year 4, 3, 2, 1, your property is likely a lot less valuable. And there's things that can offset that. There's, market cycles, cap rate compression, maybe some rental increases, things along those lines. But that's still taking a big leap of faith that all of those stars are going to align. And Where traditional real estate can go up and down in value, like your multifamily deal or your single family house, but they generally are not going up and down just by the nature of the lease term going down. They're going up and down tied to a market condition or a performance of the asset, where the net lease could be performing just perfectly. It's just the lease term burned off. And so you're eating away at your appreciation. So going back again to liquidity, yes, you can sell that deal. You have control of selling that net lease asset, but are you going to, if you do need that money 4 years from now because an emergency pops up, you're likely to sell it at a loss. And so you got to balance those factors out. Now, again, you as an investor might have the ability to hold that, renew the lease, and then potentially have value there to exit the asset at that point in time. Or if you're fortunate enough to find a property that's a 20-year lease so that maybe you hold it for 5-7 years, you still have a substantial term to sell. But what I'm seeing out there, I do come from a real estate operating background, and I do buy net leases on the, in the hundreds of millions of dollars. A lot of big corporations aren't signing the 20-year lease anymore. A lot of these are, anywhere from 5, 7, 10, 15 years on the high end. There's always an exception to that rule, but that's what we're seeing out in the marketplace. And so to go back to the comparison, you're taking a lot of inherent risk if this is a big piece of your net worth. Now, if you're worth $100 million, $150 million, and this one $5 million triple net building is a small piece, you might be able to take that risk. The other thing is that renewal. What is it going to take to renew that lease? Some tenants will just renew it or go right into their option period. No strings attached. Some tenants, you might have to work through a leasing broker and pay a leasing commission. So you got to think, some people buy a triple net because they go, oh, this is a higher cash flow than maybe a DST. But you got to amortize in your potential costs down the line. And so when you look at a triple net over a 10-year period, if at that 10 years, the building's older, yes, the tenant before was saying, I'll take care of the HVAC, the roof, the parking lot, but they probably knew, they're smart, their real estate departments probably knew nothing's going to go too wrong on this. It's a newer building. But in 10 years when my lease comes up, I'm then going to switch to a double net lease structure, or I'm going to go to my landlord and say, you know what, we want to be here, but we would like to have, X amount of dollars to upgrade, our deferred maintenance or whatever it might be. And you could fight that and try to get them to pay for it. But my point being is it's not as passive as people might think it is. It also can cost a lot of money, especially if you have to completely reposition a building. And you got to think about your future. Not all of our clients, but there's a lot of clients who they're moving away from active management because they're tired of it and they're at a stage in life where they want to enjoy retirement or focus on their actual professional life, whether they're an attorney, doctor, whatever that professional life that takes a lot of time. And imagine thinking 10 years from now where you're going to be. You got to think that. You can't just think in the now. And DSTs provide a truly passive nature with asset managers that are taking care of all the things that I mentioned. The same headaches, the same curveballs, the same hurdles, the same lease negotiation, that's all going to take place in a DST structure too. That didn't solve anything, but what it did do is a client that has $1 million, $5 million, $10+ million, they didn't go all into one property. And so if, God forbid, one of the 5 properties they diversified across has to be repositioned, has to utilize capital to reposition that property or go a period without cash flow, your income didn't go to zero. You also didn't have that headache and all the legal costs of hiring and figuring out all the people. I have a theory, triple nets only became popular, kind of coming out of the 2008 cycle for the retail investor, kind of that what we call or heard of flight to quality. And so a lot of those early triple net properties back in 2010, 11, 12, 13, 14, 15, those were the times when they had 20-year leases or 15-year leases. Those are all about to come due about right now. The same thing that you hear in the world of debt, the big bubble that people are saying, oh, the debt's going to come due in 25, 26, 27, and there's going to be a lot of headaches and repositioning and people that get themselves in a pickle. I think that's going to happen in the net lease world too, because a lot of those 15, 20-year leases that were popular back in the day, all those Dollar Generals, all the fast foods, all the kind of those $2-5+ million properties, those leases are now coming due. And that's why you guys have probably read in the headlines, the big, every big corporation shutting down locations, repositioning locations. Maybe they discover 20 years ago, these two boulevards were the popular spot. Now over here is the popular spot. And so the unfortunate thing is most triple nets that are in the price point for a retail investor or the everyday landlord is typically the stuff that is more moving with demographics, like retail, like fast food, like medical. It's all tied to an ultimate consumer. And so what are the triple nets that might not necessarily be location, the importance of the location are a logistics facility, a FedEx distribution center, an Amazon distribution center, or a more strategic piece of real estate for a company that isn't reliant on two boulevards. They're reliant on an MSA. So you want to understand your MSA and how that relates to that particular tenant. But they're not reliant on Street A and Street B that could be different 15 years from now. And we still have risks with those logistic type or more mission critical type buildings. But the biggest problem of why the retail investor doesn't have access to those net lease properties is a lot of times they're a lot more expensive. Those are the ones that are generally for sure going to be over $5 million, oftentimes 10, 15, $20 million buildings. And yes, we have clients who are in exchanges of that size, but the vast majority, are below that number for individual exchanges. And so I think that's, again, if you're comfortable with the hold period and the not so much liquidity factor that maybe a general piece of real estate can have, the DSTs can make a lot of sense for the passive nature. And just to reiterate, the most important thing is the concentration risk. And so I can go on and on about all the different pros and cons of net leases. I mean, we can go on conversations and conversations of someone who might think they're getting into 100% passive net lease, but not realize that it is a double net, or that it's on a reimbursement and you're still having to do all this accounting and all this repair work and submit invoices. And so there are fully, passive net leases, but the vast majority these days, again, retailers and tenants have become smarter and put a lot of it back onto the landlord and took off that liability. And so I would just encourage, again, a triple net could be very much right for your situation. We're not here to say that it is or it's not. Everybody's situation's different. But I have, and a lot of people at our company have had significant experience within the net lease sector, both as an owner. I'm an owner of many assets on the net lease structure. I'm an operator on the net lease structure. And we've had a lot of investors across all different sponsors and institutions within the net lease sector. There are pros and cons, and we are happy to discuss those with you, even on certain tenants. You name the tenant, we've probably have had an investor with that tenant, most likely. And so we can at least use that knowledge to walk you through so you make a decision. The last thing I would say, and I know this is long-winded, but in the net lease world, the other thing is generally a 1031 exchange has a number you need to replace. So you sold your apartment building for $4.6 million. you're looking at net lease properties. What is the chance you're going to find an exact $4.3 million net lease property? Probably little to none out there on the exact number that you need to replace to have that full tax deferral. And so another unique way that people utilize us for the DSTs that are still wanting to be in this active piece of management, or net leases are right for them, for their situation, is using us as a cover. And so instead of a real estate broker knowing that you have to replace $4.3 million of purchase price, instead of them showing you a $6 million net lease, that might make a lot of sense, but now you're going to have to add in more money to that exchange or take on more debt to buy that. You can now give yourself flexibility to buy a triple net below $4.3 million and use the DST to cover that exchange. So that's kind of my 2 cents so far on the net lease subject. I could think of a bunch of others, but just, again, takeaways, that concentration risk, that understanding of the future management risk you have on that asset when that lease comes due.